When the economy takes a nosedive, most people tighten their belts and brace for the worst. But the wealthy? They play by a different set of rules. Instead of panicking or cutting back, they stay calm and look for new opportunities to grow their money. Their secret isn't just having more cash. It's knowing how to use it smartly when times get tough. Let's break down the strategies that help them thrive while everyone else is just trying to hang on. When most people hear the word recession, they think of layoffs, shrinking paychecks, and a lot of financial stress. But for the wealthy, recessions can actually be full of hidden opportunities. Instead of panicking, they see downturns as a chance to buy valuable assets at a discount, diversify their investments, and even boost their income through smart moves like picking up dividend-paying stocks or real estate. By staying calm and thinking long-term, the rich often come out of tough economic times even stronger than before. It's less about luck and more about having a strategy when everyone else is cutting back. When the economy gets shaky, one of the smartest moves you can make is to diversify your investment portfolio. This simply means spreading your money across different types of assets, like stocks, bonds, and even gold, instead of putting all your eggs in one basket. Diversification helps cushion the blow if one part of the market takes a hit, because other investments might hold steady or even grow. Wealthy investors often use this strategy to protect what they have and even find new opportunities when things look rough. By mixing things up, you're not just playing defense. You're also setting yourself up for long-term growth, no matter what the market throws your way. Gold has a reputation for holding its value when prices everywhere else are rising. That's why, during times of inflation, top investors like Morgan Stanley's chief investment officer suggest putting a chunk of your portfolio into gold. Unlike cash, which can lose buying power as inflation climbs, gold tends to keep pace or even increase in value. By allocating around 20% to gold, investors create a safety net that helps cushion their wealth against the ups and downs of the economy. It's a classic move for staying resilient when the cost of everything else is going up. Dividend-paying stocks are like the reliable friends of the investment world, especially when the economy gets rocky. Companies in sectors like consumer staples and healthcare tend to keep paying out dividends even during tough times, because people still need essentials and medical care no matter what. This steady stream of income can help investors ride out market ups and downs without having to sell their shares. It's one reason why the wealthy often lean on these stocks to keep their cash flow strong when other investments might be losing value. When the economy takes a hit and markets get shaky, most people worry about losing money. But the wealthy see these moments as opportunities. Instead of panicking, they keep cash on hand so they can swoop in and buy high-quality companies or assets at a discount. It's like shopping the clearance rack for investments, snagging valuable stocks, real estate, or businesses while prices are low. As the market recovers, those smart buys can turn into big gains, helping the rich get even richer. When the economy takes a hit, real estate can actually become a smart move for those with cash on hand. Property prices often drop during downturns, giving savvy investors a chance to buy homes, apartments, or commercial spaces at a discount. Not only do they benefit from snagging assets at lower prices, but renting out these properties can create a steady stream of income, even when other investments are shaky. Over time, as the market recovers, the value of these properties can bounce back, adding another layer of potential profit. It's a classic example of turning tough times into long-term gains. When the economy gets rocky, having cash ready to go is like having a superpower. The wealthy know that liquidity, basically money you can access fast, lets them jump on deals that others might miss. If stocks or real estate suddenly drop in price, they don't have to scramble or sell off other investments. They can swoop in and buy at a discount. This flexibility means they're not just surviving downturns. They're actually finding ways to grow their wealth while everyone else is playing it safe. In short, cash on hand gives them the freedom to act quickly and confidently when opportunity knocks. When the economy takes a hit, the wealthy don't just sit back and hope for the best. They use smart tax strategies to protect their money. One popular move is called tax loss harvesting. This means selling investments that have lost value to offset the taxes owed on gains from other investments. By doing this, they can lower their taxable income and keep more cash in their pockets. It's a clever way to turn a market downturn into a financial advantage. When the market takes a dip, Some wealthy investors see it as the perfect time to convert their traditional IRAs to Roth IRAs. Why? Because when investments are down, the tax bill on converting is lower since you're paying taxes on a smaller amount. Once the money is in a Roth IRA, any growth is tax-free, and you won't owe taxes when you withdraw it in retirement. Plus, Roth IRAs don't require minimum distributions, so your money can keep growing as long as you like. It's a smart move that turns a temporary downturn into a long-term advantage. When the economy takes a hit, you might think the rich would pull their money out of the market and wait for things to calm down. But that's not usually how it goes. Instead, wealthy investors tend to reallocate their portfolios, shifting from riskier assets to more resilient ones like dividend-paying stocks or defensive sectors. This approach helps them ride out the storm while still keeping their money working for them. By staying invested and adjusting their strategy, they're set up to benefit when the market eventually recovers. Staying ahead in a shaky economy isn't just about picking the right stocks or assets. It's also about staying informed and connected. Wealthy investors make it a habit to keep up with the latest financial reports, economic forecasts, and expert opinions. They don't go it alone either. They regularly consult with advisors and network with other high-net-worth individuals to share insights and spot new opportunities. This constant flow of information helps them make smarter, quicker decisions, especially when the market gets unpredictable. In short, knowledge and connections are some of their most valuable assets. When the economy takes a hit, most people panic and rush to sell their investments, locking in losses and missing out on future gains. The wealthy, on the other hand, stay calm and stick to their long-term plans. Instead of selling off assets in a downturn, they look for opportunities to buy quality investments at a discount. They also avoid putting all their eggs in one basket by diversifying across stocks, bonds, gold, and real estate. By keeping a cool head and making strategic moves, the rich sidestep common pitfalls and set themselves up for even greater success when the market recovers. You don't need a billionaire's bank account to put these strategies to work for you. Start by diversifying your investments, even if it's just a small amount each month. Think about spreading your money across stocks, bonds, and maybe a little gold. Look for companies that pay steady dividends, or consider real estate investment trusts if buying property isn't an option. Taking advantage of tax-saving moves, like using retirement accounts or offsetting gains with losses, can also boost your bottom line. The key is to stay informed, keep a long-term mindset, and make smart moves consistently, no matter the size of your portfolio. So, what are the rich actually doing when the economy gets shaky? They're not panicking. They're diversifying their investments, scooping up undervalued assets, and using smart tax strategies to keep more of their gains. Instead of pulling out of the market, they shift their money into resilient sectors and stay ready to act when opportunities pop up. The big takeaway here is that building wealth during tough times isn't about luck. It's about having a plan and sticking to it. If you start thinking like the wealthy, you can set yourself up to not just survive a downturn, but come out even stronger.